Hello, all. Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on global risk versus local growth. What's next for warehousing? We sincerely appreciate you taking the time to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Krishnan S. Iyer, CEO at NTR Invid Trust. Mr. Ashish Shah, CEO at EcoBox Industrial Parks. Ms. Divya Verma, CFO at Wellspan One. The session will be moderated by Mr. Divyesh Shah, Director at CareEdge Ratings. We will commence the session with the presentation by Mr. Amit Chanchlani, Assistant Director, and Mr. Ananya Mishra, Analyst at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key into their panel. We will take up your queries at the end of the discussion. Now, may I invite Amit to make the presentation?
Yeah, thank you, Mamta. Good evening and a very warm welcome to esteemed panelists and participants attending this webinar today. I am Amit Chanchlani and today I'll be presenting CareEdge Ratings perspective on the evolving landscape of India's warehousing leasing sector, shaped by robust domestic growth and ongoing global uncertainties. So in this presentation, we'll provide a brief overview of the macroeconomic environment and the warehousing landscape, including private equity investments, trends of supply and absorption in the sector. We'll also briefly cover insights on Tier 1 cities. Following this, we'll discuss the operational and financial performance of key players in the sector before concluding with the rating distribution of CareEdge's rated portfolio and outlook for the segment. So in this slide, we have focused on the key messages that are influencing the warehousing leasing dynamics. The segment continues to demonstrate robust growth driven by sustained demand from 3PL, that is logistics players, and manufacturing sectors, alongside significant contribution from e-commerce and retail players. India's organized warehousing stock currently stands over 280 million square feet and is projected to nearly double to 500 million square feet by 2030. This growth is supported by private equity and institutional investors, with major institutional players like GIC, CPPIB, Blackstone, among others, expanding their presence in Grade A warehouses. Additionally, there is emphasis on sustainability as occupiers are increasingly prioritizing energy efficient and eco-friendly infrastructure. On the leasing front, rental rates are expected to rise steadily in the range of around 3 to 5%, and Grade A warehouses are expected to maintain vacancy rates below 10%. As suggested by CareEdge's rated portfolio, the credit profiles of warehousing operators remain stable, with debt to EBITDA projected to stay comfortably below 5.5 times in near term. All these dynamics paint a favorable medium-term outlook of the sector, although broader economic uncertainties exist and the impact of same will remain monitorable. Let's have a look at macroeconomic overview and developments in the sector. India's warehousing sector is experiencing robust growth driven by strong macroeconomic fundamentals and key government initiatives. While global GDP growth hovers around 3%, India's economy is expected to expand over 6%, led by manufacturing and services, supported by stable inflation between 4.5% to 5.5%. Government programs like Pradhan Mantri Gati Shakti are enhancing multimodal connectivity, cutting transport times, and promoting new logistics parks. The PLI scheme is also accelerating demand for Grade A warehouses by boosting domestic manufacturing. Complementing these efforts, the 2026 Union Budget's air cargo upgrade is further focused on boosting warehousing efficiency by streamlining logistics, cutting delays, and enhancing export competitiveness. Though these initiatives collectively create a favorable ecosystem for the warehousing sector, however, the mixed impact of US tariff and proposed GST restructuring will remain monitorable in medium term. Now let's examine the trend of private equity investments in the warehousing sector. So PE investments in Indian real estate have steadily grown from 2021 to 2024, with the office leasing segment traditionally being the top choice for institutional investors. Warehousing has consistently been the second most preferred asset class, except in 2022, Notably, in 2024, the warehousing sector even surpassed investments in office spaces, capturing around 38% of total PE investments, up from the usual 20 to 30% share. While momentum has remained robust in recent years, a shift is expected towards residential and office investments in calendar year 2025. Going forward, PE investments will continue to be driven by a strong preference for grade A assets with high demand supply gap. However, an increasing inclination towards greenfield developments, a favorable outlook for even other real estate asset class, and a more cautious investor stance amid geopolitical uncertainties will be key factors to watch. So this slide presents absorption and vacancy trends along with key factors driving demand in the warehousing sector. As seen in the left chart, transaction volumes have consistently crossed 50 million square feet over the past 2 years, leading to a steady decline in vacancy rates. Vacancy levels have consistently remained in single digit in recent years. CareEdge ratings expects vacancy level to remain in the range of 7 to 8%, supported by sustained demand. So demand for grade A assets is being driven by growth in logistics, manufacturing, PLI linked sectors, and e-commerce. Government-led infrastructure development is further boosting leasing activity, especially in emerging logistics hubs. However, rising land costs are prompting developers to be more selective and efficient in site planning and logistics park design. Now let's have a look at overall warehousing stock in India. Driven by the rising demand, the total grade A warehousing stock in India is projected to grow to over 500 million square feet by 2030 with robust CAGR of over 10%. NCR will continue to hold largest stock amongst top clusters, while warehouse leasing in industrial hubs is expected to rise with heightened manufacturing focus. Pune is emerging as one of the key logistic destinations due to its proximity to MMR and strong automotive manufacturing base. Chennai, with its port facilities and robust manufacturing base, is similarly witnessing substantial growth in warehousing demand. So this growth is not only confined to just top clusters, it is also extending to tier 2 and tier 3 cities as well. Cities like Lucknow, Coimbatore, Vishakhapatnam, Surat, Patna, Ludhiana, to name a few, are increasingly becoming significant warehousing markets. Next, we'll explore city-wise insights, focusing on key micro markets, occupancy, and absorption trends. So if we look at the top 6 markets in India, total warehousing space is around 280 million square feet currently. Of this stock, NCR and MMR hold more than half of the grade A stock. Let's talk about MMR. Demand here is primarily driven by 3PL and manufacturing, making up over 80% of leasing activity. The key logistics hubs include Bhiwandi and Panvel clusters. Bhiwandi remains front runner with over 80% of MMR's leasing in 2024, while Panvel's share is rising steadily due to improved connectivity and modern grade A supply. Occupancy in the region has remained strong for years at over 90%, while absorption in the region has nearly doubled from the level of 6 million square feet before 2022 to uh, around 12 million square feet in 2024. Coming to NCR, it continues to be one of the India's largest consumption hub with absorption consistently ranging between 8 to 12 million square feet. Lately, e-commerce demand in this region has softened due to excess capacity built in previous years. However, sectors such as 3PL, manufacturing, and FMCG are emerging as primary key drivers now. Key micro markets, including Farrukhnagar, Sonipat, Bhiwadi, and Ghaziabad, have witnessed healthy leasing activity driven by strong connectivity and availability of modern grade A warehousing facilities. Occupancy has held healthy between 88 to 92% over the last 3 years. Infrastructure projects like dedicated freight corridor, expressways are expected to keep the demand resilient. So if we look at Pune and Chennai markets, these cities have shown similar trends. In Pune, the Chakan-Talegaon cluster remains the city's primary hub, benefiting from excellent connectivity to Mumbai and Nashik. The expansion is visible from rising absorption, which rose from 4 to 6 million square feet in 2021 to consistently over 9 million square feet between 2022 to 2024. Occupancy in the region remains over 90%, driven by strong demand from manufacturing and automotive sector, as covered earlier. Chennai's strategic coastal location with major ports like Chennai, Ennore, and Kattupalli has established it as a vital trade and industrial hub. The city's proximity to the sea, growth in automotive industry, presence of Chennai-Bangalore industrial corridor, cold chain logistics for pharmaceuticals and seafood are the key factors driving the demand. Occupancy in Chennai also stayed over 90% in past 3 years. Similar to Pune, heightened industrial activity has driven the absorption up to over 6 million square feet in 2024 compared to 3 to 4 million square feet previously. So coming to Bangalore and Hyderabad market, Bangaluru's warehousing market saw strong leasing activity in 2024 led by manufacturing, which accounted for over 40% of total demand, followed by retail and e-commerce. Growth drivers included rising e-commerce and quick commerce, a thriving tech ecosystem, urban demographics, and expanding electronics and FMCG manufacturing. Key micro markets like Bannerghatta and Hoskote industrial area recorded healthy leasing due to strategic locations and strong connectivity. Occupancy remained high at 88 to 95%, while absorption more than doubled from 3 million square feet in 2022 to over 7 million square feet in 2024, indicating sustained demand. So Hyderabad's warehousing activity is concentrated in three key clusters: Mechal in north, Patancheru in west, and Shamshabad in south, alongside major highways. The region supports a diverse industrial base, including seed processing, logistics, and electronics manufacturing. Manufacturing and retail accounts for nearly 30% of transactions. Occupancy remains moderate at 85 to 90%, impacted by significant new supply between 2021 and 2023. Absorption here at 1 to 3 million square feet is lowest amongst the top six cities. This is primarily due to Hyderabad's relatively limited presence of large e-commerce and 3PL players, which in other cities serve as consistent demand drivers for warehousing space. Now I would request Ananya to take forward the presentation on overall rental trend in India, as well as operational and financial trends of warehousing players.
Thank you, Amit, for the industrial insight. Let's have a look at the rental trends. While transaction volume have grown, rental are steadily moving up in the most of the market. Among the top six cities, Mumbai commands the highest rentals, followed by Pune are some of the micro market like Chakan and Talegaon are the prime industrial cluster. Due to paucity of the land parcel in this area, the rental rate stood high. Other prime markets also continue to witness surge in the rental rates with growth in logistic and manufacturing industry. Looking ahead, rentals are expected to continue rising in the near to medium terms, supported by higher construction cost, increased investment in sustainable facilities, and regular rental escalation. With growing e-commerce and rental activities in the Hyderabad market, average rental rates have surged significantly. Having reviewed the overall performance of the warehousing leasing segment, let's now delve into the financial performance of the key player. CareEdge ratings have analyzed a sample set consist of InvITs and a large corporate, together holding a warehousing stock of over 65 million square feet. As we have discussed, the segment has witnessed a significant expansion over the last few years. As a result of non-inverter stock in our sample set has more than doubled from FY 2020 to FY 2024. Additionally, the emergence of InvIT in the recent years with sizable portfolio has further driven growth. Despite the significant addition of stock, occupancy has remained strong, consistently near 90%. Rental rates have been gradually increasing with InvIT mostly holding build-to-suit asset. Average rents are expected to rise significantly. For non-inverter stock, we expect steady rental growth with average rates remaining close to 30 per square feet per month. CareEdge ratings warehousing portfolio has maintained a stable debt portfolio with estimated debt to rental ratio below 4.5 times and debt to EBITDA below 5.5 times for FY 2025. The segment is less vulnerable to economic cycle and its impact during the pandemic has also remained limited. With significant stock under construction gradually becoming operational, debt coverage metrics have steadily improved. Driven by growth in e-commerce, quick commerce, and manufacturing, the segment is well positioned for a long-term growth compared to office and retail leasing. Warehousing carries slightly higher leverage given more stable operation and growth potential. Let's now move forward to discuss the CareEdge rating credit perspective on the sector. In this slide, we have presented the rating distribution of leasing companies rated by CareEdge rating as of July 31st, 2025. From the dataset, it can be seen that over 85% of the portfolio fall within the investment grade, that is BBB minus and above, indicating a strong credit profile of the portfolio. Companies in the higher rating category typically belong to organized sector backed by strong parentage and robust fundamentals. Furthermore, high credit rating in the warehouse sector is also supported by robust cash flow structure, high occupancy with strong counterparties, and stable financial metrics. As the chart illustrates, the credit ratio, which measures the ratio of rating upgrade to a downgrade over the given period, the data show a notable improvement, with the credit ratio rising from below unity in previous year to 2 times or higher, indicating a greater number of upgrades than downgrades. A key highlight is that there was zero downgrades in the FY25 as well as 4 months of FY26, marking a significant shift in the credit quality, largely attributed to stable financial performance of the players. Having reviewed the overall financial landscape, now let's highlight the key takeaway around the demand drivers, challenges, outlook, and emerging trends that is shaping the India's warehousing sector. Key demand drivers include government initiatives like Make in India, increased infrastructure investment, expansion of cold chain logistics, and China Plus One strategy, all fueling demand of the modern warehousing. However, the sector faces challenges such as high land cost, limited rental growth, regulatory delays, and rising costs related to sustainability and technology. Emerging trends point to a growing focus on sustainable warehousing, increased adoption of IoT and AI of the inventory management, and the expanding role of InvITs, a financing vehicle. Overall, the outlook remains positive, driven by strong foreign investments and growth opportunity in the emerging Tier 2 and Tier 3 market. With this, we conclude our presentation and thank you everyone for patiently listening. Over to you, Mamta.
Thank you, Amit and Ananya. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Divyesh Shah to take over the session, please. Divyesh Shah is a director at CareEdge with a total work experience of more than 25 years, of which he has been associated with CareEdge for about 18 years. He has worked with the Research and Ratings Division at CareEdge and is the vertical head of the real estate sector. Divyesh is a part of various rating and criteria committees at CareEdge and is an MBA by qualification. Over to you, Divyesh.
Thank you, Mamta. Thank you, Amit and Ananya, for an engaging presentation. I'm truly grateful to all our panelists for taking out time today and joining us for this panel discussion. In our panel today, we have Mr. Krishnan S. Iyer. He is the Chief Executive Officer of India InvIT Trust, having an AUM of 20 million square feet that is listed on NSE. He also serves as a non-executive board member in a manufacturing company which is listed on BSE and NSE, and a global technology company. He is an undergraduate of BITS Pilani, a postgrad alumni of MIT Sloan, and holds a diploma in International Financial Reporting Standards, IFRS UK. He is also a visiting faculty at IIM Bangalore. A very warm welcome to you, Mr. Krishnan. Our second panelist for today is Mr. Ashish Shah. He is the Chief Executive Officer at EcoBox, a leading industrial parks company. Ashish Shah is a distinguished professional with 28 years of experience in organization building, development management, and real estate investment. He is a qualified CFA India, CA, and CWA. Ashish has held leadership roles at Arthur Andersen, EY, and KPMG with expertise in risk management, deal structuring, and financial strategy. Over the past decade, he has driven major acquisitions in Mumbai's MMR region, and in his previous role as CIO and head of leasing at Logos India, he successfully led the pan-India development of industrial and warehousing assets. Welcome, Ashish. And our third panel for today is Ms. Divya Verma. She is the Chief Financial Officer of Welspun One. Divya has an extensive experience spanning 24 years, encompassing various areas in finance. She has before held key position at India's first power transmission company, an InvIT sponsored by Sterlite and KKR, to name a few. She has completed her Bachelor's of Commerce from Delhi University and is a qualified chartered accountant. A very warm welcome to you too. So great. We have an illustrious panel today who will be offering their valuable insights into the current state of the warehousing sector. Starting the panel discussion, I would like to have views from Mr. Ashish. As highlighted in our presentation, the warehousing segment has attracted the highest private equity investments in 2024. Yet, rental growth has remained largely stable. Looking ahead, which segments do you anticipate will drive growth, and what are your views on the potential for improved rentals?
Thank you, Divyesh. Uh, from our vantage point as developers and asset owners, I think there are three things that kind of stand out. One is the time of quality has come over quantity. People are now no longer looking for sheds. They are looking for high compliance, high quality, and India. Bear in mind for the last barring the last 8 to 10 years, was exposed to almost 4 5 decades of subpar storage sort of structures. So bear in mind we're going through a transition, and that's one thing that stands out, that occupiers now prefer going in an institutional going the institutional way, where the delivery is certain, the operations are seamless for occupiers. And that's one of the reasons we have, people like EcoBox have got institutional sort of capital backing, and our approach to the development is, fairly focused in a risk managed manner, so that the occupier has a seamless delivery. Your question was really on, what's the underlying rental growth. I think India, as I said, is going through significant transformation with this clearly India-centric challenges. So supply has kept up wherever there was more demand coming up, and supply has kept up because there are a lot of new land parcels that have become available. Tier 2 and tier 3 cities have seen significantly better rental growth. But I think more than rental growth, I think we should talk about premiumization of this whole warehousing and industrial park development. Are we giving certainty? Are we giving value added services to the occupiers? And that's where we've seen, where we've had active conversations with understanding a customer's need. We have been able to justify rental growths, which are beyond, let's say, market averages. And so I think the key to it is that, very similar, that for us to go beyond the averages, we have to add value in terms of understanding customers' expectation.
So what is the new trend, if I can ask, in customer expectations that you are seeing in the last 2 3 years over the past decade?
I think ESG in the last 3 4 years has kind of stood out, but the cost is still to be borne by the developer, right? So they expect all these nice things that come along with IGBC Platinum. So the way we look at it is that the new thing that they want is high quality, certain, but the rental solution has to be built along with the customer. So if you have a passive leasing strategy, it doesn't work. You are not able to achieve the desired targeted rents. So if we go via the giving an entire leasing solution, what else they can do? The other thing that people seek is assistance on, and we Ecobox Industrial Parks also has a heavy bias towards building industrial parks. is to actually how do you enhance capacity, space being constrained. For example, one of our customer uh, has won large contracts and wants to build and expand capacity. Uh, Earlier they were at 70-75% utilization. Now they want to use it 125. So, we need to come up with solutions on how quickly can you build a mezzanine structure or give them extension outside. At the same time, remain fully compliant, having active discussion. So one of the things that we've observed is people want growth, but they may not necessarily want to go out and take on more space. Are there opportunities that we can make the space efficient?
Efficiency
So
norms.
they've let our designers enter into their sort of planning process. So that's something which we find it new. Divyesh?
Okay, thank you, thank you. So now, Mr. Krishnan, if we can have your views on the InvITs. There are two major InvITs in India today. So what is the future? What is your view on the future of warehouse InvITs in the country? How do you see this segment evolving, and any factors that you think will drive the growth over here?
Sure. I think, thank you for having me over here. So InvITs are a recent phenomenon. I guess they've been there. They haven't even hit that 10-year mark as yet. And both REITs and InvIT. REITs came in much later. And we were the first warehousing industrial park InvIT to get listed. The fact that we had a private equity backing and we had some marquee, investors that helped us in terms of our listing. But what has happened is it hasn't yet got democratized. Because if you ask me, InvITs and REITs are very good products because, the moment I'm an InvIT, I'm extremely compliant. I mean, you're a rating agency, you should be aware of it, be it in terms of disclosures and everything. And I have to distribute after my expenditures and after a requisite cash, which I set aside. I have to distribute, 90% of the cash that I have. I'm forced to distribute. So there's a lot of discipline in InvIT, right? And we have some marquee investors on our InvIT. And on top of it, we have, since we listed, I think when we listed, our operational portfolio was about a little over 14 million square feet. Today, out of the total assets under management of 19.2 million square feet, leaving aside the ROFO asset, which is another 6 million. So our operating assets are 17 million. So how is it? Because now what has happened is InvITs are primarily platforms where you kind of, it enables you to raise capital, both equity and debt by tapping into the capital markets at far better financing rates, right? Because our bondholders, IFC and NABFID, one is marquee sovereign supranational entity. The other is India's leading infrastructure finance arm, and we've been able to secure a 15-year bond. And as from NABFID, and we were the first InvIT to issue sustainability-linked bonds to IFC, where the pricing is determined not just by our financial capabilities, by a lot of other parameters like social development goals and meeting a few standards and all that. I think these are great platforms. We just found a lot of interest amongst foreign institutional investors, wealth firms and family offices. But where I would like some attention over here is I would want mutual funds and I would want pension fund, the Indian pension funds, the government pension funds to come in. Because we distribute on a quarterly basis ever since we listed in Feb 2024. To date, we have done 6 distributions, and we continue to, we just not distributed, we even increase our distribution because we've grown. As I mentioned, we've grown. I think InvITs will grow. And there'll be other InvITs which will come in, just not into warehousing industrial park. There'll be other InvITs coming in, be it housing accommodation, be it data centers, or be it, things. And so I think it's This is something that is to watch out for.
Yeah, right. Our conversations also say two things. One, warehousing companies, as they grow bigger, they want to bring in their InvIT platform. Real estate is going under the REIT platform, where there are now five. If I include retail, there are five listed REITs there.
Sure.
Or on the InvIT side, I think we'll have more from the roads or power or the transmission segment.
Right.
May then come in. Right.
Sure. But here, if I may just add, if
Yeah,
you
yeah.
look at if you look at transmission, if you look at road, these are not perpetuities; these are annuities, because these are concession agreement. No doubt, these are backed by a solid receivables, be it kind of in India or whatever it is. But having said that, what we have, this InvIT, it's more like a reach, because it's a perpetuity.
Globally, they call it REIT only. I think in India,
In India, it's called
we
an
have put
InvIT
it under
because
InvIT and REITs for real estate over there.
correct, because warehousing comes under infrastructure. In India, it's called an InvIT. Yeah,
Yeah, also they call it REIT only.
yeah.
Great point. Great point.
Yeah.
So, while we have looked at the segment demand looks good. There are warehousing players. There are InvITs which will come in. If I can ask Ms. Divya more on the supply side issues. So, as the warehousing segment in India is dominated by grade B assets, in view of this, is acquiring a grade B asset and upgrading them to a grade A building better, or building a new grade A asset? How do you see the cost economics playing out?
Thanks, Devesh, and thanks everyone for having me here. So I think the important question, but we are grade A developers. So I'll kind of emphasize on what we do, and we are good at doing it. We have three asset classes, primarily Pulse, Proxima, and Gateway, and all are in grade A. We are IGBC grade A Platinum certified. And I do kind of vouch for it. It will always be better to be in a grade A. And in the coming era of clean energy, green energy. So grade A is always preferred. We have clients like Amazon who are kind of global standards. They look in India for global standards of architecture or warehousing developments. Previously, yes, predominant market was of grade B, and there are a lot. But then once you have a grade B, it's not so simple to convert into grade A, considering the length, the height of the building. There would be certain limitations. So grade B would have its kind of advantages of cost, but in today's era of, as I mentioned, of the kind of marquee customers we are targeting, it's always grade A.
Grade A is preferred.
Yeah. So I vouch for grade A to build in first time right, considering there would be limitations of grade B. And yes, in case of economics, it could be some marginal saving. Grade A comes at say, approximately from warehouse 2,000 rupees square feet. Grade B could come at, say, around 1,300, and incremental cost of, say, 500 could be there to convert, but with some limitations. So you might not, grade B could be, faster. It would be less compliant, less safety protocols. But grade A is something, we have to be focused on, and that's what we do. So I vouch for grade A, although
More
economics
of
would say,
you look more for
economics
the
would
greenfield
say,
projects.
yeah.
Great. But in a land constrained city, and especially like Mumbai, and one of the geography micro market is Bhiwandi. So there, do you see making it sense of us? Cost economics may or may not be favorable, but given the constraint, land is the primary ingredient. Do you see, and how do you see economics out there? Maybe it may not be your company's focus today, but your view in general.
So at NTS, we are creating multi-storied grading. So we are pioneer in India in doing it. We are coming up with one of the building in Wagle estate. That's around 1 million square feet area we are developing. It's multi-storied. It's mix of warehouse retail. So economics will also make sense. Usability, need of an hour for the Pulse in-city models. And even our gateway project, which we have constructed in JNPA within around 55 acres with 4.4 million square feet. Again, it's marquee one, grade A, multi-storied with RAM, as they are in other parts of the globe. So we are trying to bridge up the economic sense with the right infrastructure.
And the requirement of the day, whatever is.
Yes.
Thank you. Thank you. If I can have Mr. Ashish's view on, there is a lot of discussion around increasing land and construction cost, which may be impacting the warehousing segment as well. So with rising land construction costs and higher due diligence timelines, do you anticipate any challenges in timely project completion? And I ask this because there is a lot of demand. Project completion will also have to match. Additionally, do you expect the lease structures to evolve? Now, we spoke of rentals, where we see more flexible leasing models or revenue-linked rents or anything new. Over to you.
Yeah, thanks. Look, I think Krishnan and Divya mentioned the kind of expectations we are trying to meet of customers. Our customers and the structures that we build on land that we purchased. So we have to make sure that the development is future proof. So we have to anticipate what that market will need, not just 5 years later or 10 years later, but till the life of it. So a lot of us are making sure that we are putting the land to the best use. Now, questions is cost of land. Why is the cost of land going up, and why are we not able to buy as quickly as we should be? The simple answer is there are title related challenges in India. So it takes a long time. And that's where the institutional resilience gets tested in terms of how quickly you are able to assimilate risks, and go through filtering criteria, whether there are mitigation plans around each of these issues that come up. But some of the lands are simply just not aggregated. So for that to happen, you need land reforms. If land reforms happen, you will see more land deals, and creating significant liquidity for the economy. But we are playing with the current set of opportunities that we have. We whenever we meet government bodies and state governments, this is something which all of them are positive about making these reforms, but like a lot of broad-based affecting a lot more people requires a consensus, and so far we haven't. And that has direct impact on the cost of land, because the land seller, even if he's selling like half an acre, he thinks it's worth value of gold. So really, how do you make sure that the land records are fairly automated? And those have a direct impact on the cost of our doing due diligence. Warehousing costs in terms of development are directly get affected by commodity prices. But on the flip side, because demand has increased across these few centers, we've seen a significant capacity of contractors who are delivering high quality structures. We've seen series of PEB factory, pre-engineered building factories in the vicinity, or are following logistics routes to deliver. And it's a fairly competitive sort of space where to a large extent we have reduced uncertainty. It does come at some price, but it's offset because a lot more player have come. So what we see in today's discussion is focused on the product, but the supply chain that supports us to build it has also evolved, and that has helped somewhat in terms of offsetting some of the costs. But again, underlying is that they will also be affected by the ups and downs of commodity prices of steel and cement. Lastly, your question was on flexibility of
These
uh,
rentals.
whether rental can be variable, and this asset class globally works slightly differently. Land is a long-term asset. Construction thereon is obviously long-term. And clearly, to match that long-term asset, you need to have a reasonably longer contracts which pays you. And for those reasons, most of us most of us are happy with having steady revenue, because that's what investors want, including stakeholders that Krishnan must be managing.
We also like that more steadier
So,
the longer and the steadier the
so we want, yeah. So I think we are in the business of giving certainty to our occupiers, to our clients, and also to our investors. So revenue share and all those ideas, they haven't even worked elsewhere in the world, unless it's like a different asset class, like an FTWZ, or short stay like a CFS. So in a conventional sort of industrial parks or warehousing, um, our preference and our as an industry has always been slightly longer contracts. Devesh?
Okay, thank you. As you rightly said, as we do ratings for so many companies, we have not seen shorter contracts. In fact, in warehousing, we have seen bit more longer contracts than maybe office. Retail, yeah, we see all this after, and more so after COVID, that came into picture, revenue sharing and all. So we also like more long contracts. As just to add on to the question to Divya, as there is a lot of supply coming in, there is a lot of demand which is being met. Ashish did speak on availability of companies who can do the construction for greenfield projects. Do you anywhere see any kind of constraints on labor or contractors for good quality products? Because we see that in certain other asset classes. I just thought to ask you as well on this.
Yeah. So I think in our sector, we do have, and since we have a good track record of development, we don't only develop for our own self, but we also do a third-party DM. We are doing it for one of our client, which is GRT Chennai. So it could be regional. We have faced some challenges in one or two regions, but then on an average, I think there's an ample supply of the right kind of contractor for infrastructure of logistics projects for construction.
Okay, so I think till now we have did hear that investments is looking good, demand is looking good, and supply will be matched accordingly. So now my next question is for Mr. Krishnan. How global REITs, of course, I mean REITs, InvITs in India, they structure their portfolio to balance logistics, cold chain, and last mile delivery assets. How is Indian warehousing progressing in comparison with global players with respect to space under InvITs?
Okay, right. So what am I? If I have to redefine, when I go and sit with, I'm not talking about, let's say, a rating agency or a client. When I go and sit with a fund manager or an investor or my shareholders, I'm more in the yield play. I'm a warehousing company, but I'm more like, because they invest in me because they want a certain yield.
Right.
And we have to understand one thing, because we've gone out and told the market that this is an X amount of percentage is what we will kind of pay every year, right? And we've delivered it, right? Now, two aspects to it. What you spoke about in terms of, I'm sure Ashish and Divya would agree with me. So warehousing is a CapEx heavy business. We are hoarders of inventory for others. People store their inventory for others. If you look at in terms of supply chain and all that, those are labor intensive business. Those are 3PL business, right? Large e-com companies, India's the world's largest, and as far as India goes, the two of the largest, plus the QCom companies, all of them are our clients, right? So what they do is they are pretty much outsourcing their capex to us. We're going and putting capital in because two things that matter. Because when Divya mentioned about grade A and focusing only on grade A, but there are two aspects to it. It's just not a question of just trying to look good. Also, the quality of receivables is extremely important. Who do you want to deal with? So that my rating doesn't go for a toss, because we are in the warehousing business, and we have to collect. We build, we fill, and we bill and we collect. The collection is extremely important, right? So one is an asset-heavy business, and that's what we are in. In terms of second is 3PL and all that is a people-heavy business. That's something I don't see any of the warehousing companies in India who are pure play warehousing players backed by institutional investors, because if they wanted to invest, they wouldn't have backed, let's say, an NDR or a Wellspun One or an EcoBox, because the type of investors is completely different. They would have backed a delivery or a a DHL or one of it. They would have gone to the public
Global.
market and picked up other stocks. So that's one part. Second is in terms of cold storage, yes, we do. We have temperature controlled facilities across India, and we see a demand for that coming in. We have India's first four-chamber warehouse, which is it's ambient, it's below 20. It's below -20, the freezer room, and it can go also another room which it can go below -50 for certain biotech. This thing. Now we don't operate it. Now we don't want to get into operations. We're very clear. I don't know how much Ashish will agree with me or Divya will agree with me, because end of the day, listen, I mean, because we the first thing is we have to pay our investors back. Because they have trusted their money with us, and they're not looking at it as something where you can make the 20, 30%, 40% gains. No, this is a business which is steady, which I will stick my net out and say it is quite safe, because the stickiness is extremely high. Unlike a residential or even a commercial, the stickiness is very, very high over here, because once a client comes in, see, from a rental perspective, compared to the asset value or compared to what they store inside, it'll be a minuscule of their total costs. However, it becomes an extremely important cog in the entire supply chain, because it's both the first mile and the last mile. You have to store whatever you produce, you have to store somewhere because you ship it out. Or if it's a consumption center, if it's right over there, you have to make sure that it is available in the warehouse because it is pushed to the end consumer. Right? So we focus on storage. We focus on how do we kind of improve storage, like what they pointed out in terms of, the 125% utilization, doing a mezzanine, or, trying to make sure that we reduce the energy consumption, give the benefits to our clients, trying to see what best, how do we design a particular warehouse. Divya spoke about the multi-story warehouse and all that, right? We focus on that. And we leave the other dynamics, like, in terms of, so we focus on storage and they focus on demand planning, demand forecasting, and investing in technology so that they know what a consumer wants.
Okay. Fair. Some good insights over there as well. And coming to, Ashish, do we see any sector specific InvITs in warehousing emerge, like maybe e-commerce warehousing? I know e-commerce is not doing well right now, or some pharma cold chain InvITs that we can look at, or this will not, it will be more multi-tenant and more focused towards manufacturing companies as of now in India.
Yeah, I don't see why not. Just the question is when. Currently, we've got Krishnan here, one of the pioneers, right? They're the first InvIT. And he's he went to a great extent explaining why he's focused on certain parts of asset ownership and yield. And that's the fact. So, clearly, as assets get hyper specialized, you would definitely see e-com InvIT maybe a decade later, where you cull out that. But right now, I don't. We're still at that stage where we're still a very small category of an InvIT or an asset class. Where folks, other investment vehicles have to come. The kind of scale of SIPs that go. They all go to the same sort of equity markets and, similar debt instruments. And, you need more InvITs for people to be aware that, let's go and invest some of those things. So it's a question of evolution and, whether they will be a location specific, like a combination of a Bhiwandi an industrial sector like Chennai. Maybe that's a sort of a great combination. I don't see any reason why. But again, it's a question of evolution. Just taking on from what Krishnan said about cold storage, very exciting sort of sector. And I think one of the audience member had posted the question.
Yeah.
It's an operator business. So we are asset owners and developers. Cold storage requires, fairly nuanced knowledge of where the demand comes, where's the ice cream required to come. Are the flowers coming from Holland required in that sub-market? Are there air-conditioned transportation assets available to pick things up? So we can build and we can invest in all the HVAC and all that stuff. But for us to ascertain what's the yield, that's where we all falter. And currently, there are no significantly large enough operator who will give us what we want, is sort of a fixed, predictable revenue, and he gets exposed to the upsides and possible downsides of filling his refrigerated place. It's simply because that sector also depends on the Indian consumer's propensity to spend on refrigerated items, right? So, if it is just a question of local produce which needs to be stored for a bit, fine. If it is ice cream, some of these ice creams that we see, they come from Malaysia. Uh, the then those are very, very small aspects. But the real thing is that flowers from anywhere from Jammu and Kashmir should be made available elsewhere. But someone should be able to afford this. So sure, if there is a product available, people will buy, but it's currently the costs are just significant, and we don't have an operator who can take on those risks and take responsibility towards folks like us. Divyesh?
Right. I think so. The evolution or the timing will be important, because I remember at a time a few decades back when retail was there, e-commerce would happen, not happen, and today we see any initiatives from the government side that
Sorry,
can help.
was it addressed to me? I missed out the last thing. You're not very audible. Could you repeat your question?
Yeah, one sec. I think I have some technical issue. Am I audible?
Yeah, you're audible. Yeah, yeah.
No, I was asking Ms. Divya on the cold chain aspect that we spoke.
Sorry, I think could not hear you completely. Again, pause.
Divya, he was asking you about your view on cold chain as an asset class, if I've got it right.
Yeah. So yeah, I think it needs a heavy investment. So unless there is an appropriate return and a use case, currently it's kind of a TE for the specific lines we intend to develop, but not as a asset class as of now because of the investments required. Multi-story,
Have
yes,
some network.
as an asset class, it works because it gives flexibility to choose a tenant, and we could be speculative. But then cold storage are an asset type which always have to be built to suit, considering the investments required.
Okay. I think we have some questions from the audience, so we can take that then, and then. So I think first question is from Pranav Balla. It is a question which all of the three can answer. By when do you expect in-city warehousing also see a large influx of institutional investments coming in?
So I can take this one. I think this is kind of on its way, considering, Zomato's and Swiggy's, Blinkits, they need in-city warehousing, and there are a lot of regulations coming from government. So, now institutionals are taking this up to create some model mix of technology. The future is like, it's use and pay, similar to Ubers. I see the future is you will have in-city warehouses available for limited duration. So I think that's the future. I see it coming very soon.
Okay. Uh, any more view on this particular question, or can I take the another
Yeah,
question?
I would say so. We do have in Delhi NCR. I'm talking about proper Delhi, Sarta Vihar. We have a urban density center, what we call it. So that there's a lot of demand for that. And the names Divya mentioned, there are clients from a mother hub perspective. And what I've seen is that this is going to grow because what happens is extremely today, if somebody wants to order an ice cream, a very simple thing, because they have to make sure the ice cream reaches that person, the particular brand that they want. So by today, I think all of them have dissected my taste, everybody's taste is what is it we buy, what is it we don't buy, and what is the price point we're willing to pay for. They've invested so much in technology, so much in this thing. I can see when I walk into one of our mother warehouses for these companies, the amount of trips, the truck, the milk runs they do, because they have to be there. And these are small units inside, but they used to stock about 2 to 3,000 SKUs 2 years ago. Today they stock as much as 10,000 SKUs.
Okay.
Because it's because the only way it's possible is because if you invest in technology and if you analyze the data, so that's where they come in. So I think in city warehousing is something that will develop. But yes, there are regulations. So you have to make sure in terms of, because these if they are in a residential area, you cannot operate a commercial establishment in a residential area. So if any of us need to go over there, we are extremely careful and prudent about getting the approvals in place before we even send the what do you call send the architect to do the additional work. So these are some of the factors that will come into play as well.
Okay.
Okay, Divesh, let me add 2
Yeah,
points.
yeah.
Look, for institutional investors, the size of in-city has to be significant for us to have economies of scale. So in-city requires us to find a good location, and it should be able to service occupiers. The other thing is, one also needs to, one of the discussions that happen in investment committees is really about, who are your occupiers, and what features and characteristics that you need from an occupier. Are they who's financing this growth? We have these quick commerce companies. Not that there is any doubt that we'll not need the service, but what's the nature of this? So, for example, they need a dark store and a hub and spoke model. So, where does the institutional play come? And is this something which, cheap delivery sustainable? Are these quick commerce going to remain consistent? Because bear in mind, institutional capital requires certainty. It requires a yield. It requires us to have customers who will be there in the event one vacates. So we are very careful to ensure that there is demand, but sustainable demand. But bear in mind, we're building something for at least 50 years.
Okay.
So that's how it works. So uh, I'm not sure as yet as to, because these are 4,000 square feet
Smaller ones
at best. And like, for example, Flipkart wants 3,000 of them in Mumbai or 4,000 in Bangalore.
Okay.
Now that is such a effort intensive. I mean, there is no one one rule that fits all. And like Krishnan said, that look, it has to be compliant, right? It's just too hard, and
I think the
it
rents
doesn't have
also,
scale.
rents and the investments also go much higher, and then, as you rightly said, the investors look for certainty and yields, then that can also be a discussion point, because we were
Yeah,
also looking at one of the segments in NCR, a BTS model, and then I think it didn't pick up from there. So one or two came up with
yeah,
much cost.
yeah.
One interesting question is: are joint ventures with landowners or long-term lease models becoming more popular as an alternative to outright purchase? I think to be less capital light in that sense. So,
You want me to take
who
it?
wants to take being the CFO?
Yeah.
Yeah.
So we have few, and I see there are such cases where either we are doing a JV with landowner, and we also have lease rights, say, or the lease around 40 years, 45 years. So we have such models, and they are picking up nowadays, considering people want to have appreciation for the generations to come on the land, and still they want to earn reasonable yields and returns. And we were actually successful even in exiting such an asset to a third party like Maple Tree, where we took an asset on lease, we developed, and it was the landowning rights got transferred, considering we did an asset sale. And yes, such models are emerging, such structures are getting more active.
Yes, sorry, Mr. Krishnan, I did interrupt you. You wanted to make a point.
No, I think what she said is fine. I mean, that's what it is. Even our UDC is on a leased land. We've leased it from Delhi Metro Corporation, and so it's a long-term lease. And so yes, it will come into play because InvITs or not, because ultimately one is, well, the moment it's an InvIT, the real asset becomes a financial asset. Else, Ashish did mention tier two, tier three cities, but today, if you look at a tier two city, the land prices are as expensive as a tier one city. If you look at places like Lucknow, Kanpur, and everything, they are as expensive as NCR. Pune, the land prices are more than Mumbai.
Yeah,
This
the
is this,
rentals are also more than Mumbai in
that's
general.
true. This is a fact. But one is the asset values have gone, but rentals have not climbed so much as all of us would like it to. So the biggest challenge again is, again, I saw another question in terms of clear title deeds.
Yeah,
So I'll answer that. But
yeah, yeah.
that's part of the challenge, because if you look at a warehouse, even a build-to-suit can be constructed in about 9 months at best. We put some good contractor, a proper project management, 7 to 9 months. We've delivered even during COVID. However, the biggest challenge is the land, aggregation of land, making sure that you go back on the TSR. Because I recollect, I think I spent more time when we listed with the lawyers rather than with the investment bankers. Because in terms of the TSR, in terms of going back, in terms of everything, so that's going to be a biggest challenge, and that also acts as an entry barrier. So how do you circumvent it? Because we as entities cannot shortcut, or we can't do a few things because all our policies. I mean, I can speak for Ashish and Divya as well, because the way we are structured and the investors who are backing us. So when you look at all this, yes, JVs are something coming into play, and land ownership. One is it's a state issue. Land is a state this thing, different rules, different this thing, and as warehouses, these are the thing about the REITs is, I was talking to Amit the other day of Embassy, the CEO. I said, you're all within the cities. I said, if you are saying your problems is difficult to aggregate land within the city, imagine us. We are way outside.
Outside the city.
It's a lot more difficult, because these are owned by some 30-40 people. You combine everything together, make it do this thing. So that will remain. I think land, that's the biggest challenge. And I think that's there to say, unless until the government kind of comes up with some real good reforms.
Okay, I think we have exceeded the time limit, so I'll take only one last question. It's the attendee name is anonymous. With government's initiative towards promoting renewable powered warehousing, are we seeing a shift towards green warehouse, solar powered facilities, EV fleets, and sustainable building materials? And what's the ROI? I think sustainability is the buzzword nowadays. So ESG. So over to each one of you, and the closing comments as well.
Okay,
Should
so yes,
I?
I think
Maybe.
ESG is the norm for future and the day, and we at all our warehouses have mandate-free solar panel provisions. We have been generating around 2 megawatt, and it could go up to 10 megawatt in all our solar plants. From IRR perspective, yes, it does help to increase the asset IRR overall. So that's the new normal. So, and I think much needed for net zero emission targets as globally what we have taken as part of the treaty.
Um, you want me to chip in, Divyesh?
Yes, yes. Both of you and Ashish can chip in. It's
40% of our portfolio would get EDGE certified over the next. We've already done the first warehouse advanced EDGE certification, which is efficient, excellence in design for great efficiencies, and which is like your, green building, this thing. And we are going net zero in about 2 million square foot of our assets over the next 12 months. So that's one part. See, one thing I want to bring in is, it is just not about when I talk about ESG or whatever it is, or SDG, social development goals. I think people need to understand this, especially investors in the government and the retail investors. See, one is we are in the infra sector, and infra creates a multiplier effect. So every warehouse, every 100,000 square foot that we build, we give employment. I'm talking about the first order effects. At least about direct employment happens about for every 100,000 square feet, about 150 people we have direct employment. We are enablers of that. And about another 200 people get indirectly employed. Okay, that's one thing. Second is the area around these places improve. Okay, the
yeah.
surrounding. We got to build roads, we got to put this thing, and all of us take up these social initiatives, adopting a particular village or a convent school or one thing, right? And the second thing is, I know it's a rating agency a webinar, but I'm bringing it up. I don't want it to be kind of completely divergent, but the second order effects is we give employment to people in the lower socioeconomic categories, right? These are people who would have been working as, I walk into a warehouse, there are these women who would have otherwise don't have a proper education. And unfortunately, so they would have been working as maids or house help or whatever it is. They come and work in a warehouse. They work for a large firm, be it a multinational or an Indian large corporate, where they're given a uniform and they're given a minimum wage. And one is they're treated with respect when they go back to their village, or where they come from. Second is, I've noticed this, and I'm saying this, since they're financially independent, the social abuse comes down on them. And I've noticed it. I can track it, and this is something we've covered. So end of the day, I think we are employment enablers, right? And yes, the government is doing a lot. There's no doubt about it, because I saw a question in terms of what are the government policies. It's been extremely
Policies.
helpful,
Yes,
right?
there's a
But
question on that.
I would want them to step up. I would want them to step up, because today, Mike, if you ask me my closing comment, today I fail to understand the different taxation, right? It's extremely difficult for me until I have the CFO next to me, or Divya is here. If somebody asks a question on taxation, I'll say, Divya, you please answer, right? And because I still fail to comprehend why it is so complicated. I want some reforms over here. And I made this thing to SEBI as well. I spoke to SEBI, and we also spoke to the ministry about this.
You're saying the taxation on the dividend distribution?
Be it the dividend
No, no.
distribution, be it trying to, no, I'm talking about, be it, setting up, be it, I mean, the input credit, be it on the GST, be it on,
GST and
there
all
are
that.
so
Okay,
many
I think
things.
that's a
There are
long.
so many things. Yeah.
So I'll echo with you.
We'll, I hope so. There's the GST meeting, and hope so how things pan out from there. So thank you, each one of you. So we have got a lot of ideas, and the views of yours. The sector looks promising. We also, as a rating agency, as we have seen the leverage position and the rating dispersion, the credit outlook looks good. In the leasing segment, no downgrades, I think, from a rating agency. That itself speaks volumes of the industry and the performance.
Yeah,
So,
thank you.
Thank
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 you,
you,
CareEdge,
Mr.
for setting
Krishna.
this up. It was
It was really a
truly
pleasure to host each one of you, and it was definitely an insightful conversation. Mamta, I now hand over to you.
All right. Thank you,
Thank
Devesh.
you. Thank you, Devesh, for moderating the session, and Amit and Ananya for your presentation. Once again, we thank all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking their time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestion, please write to us at the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.
okay. Thank you.
Thank you. Thank you.